football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
Hey everybody, welcome into the podcast. It's Red Zone Retirement Program, Simple Investing, Smart Future with John Mears and myself, here to talk about, unfortunately, not the brightest of or the happiest of subjects, I suppose, but it's the navigating our financial situation once we've lost our spouse, our loved one. Unfortunately, we have to talk about it because it's going to happen. The mortality rate is what it is. We're all checking out of this hotel at some point. So we got to talk about some things so that we're, when we're emotionally a mess, we're not making things worse by making some bad financial decisions. So we're going to cover some strategies and mistakes and some things to ponder in this arena, which again, unfortunately is going to happen to all of us. So we're going to dive into that this week on the podcast. John, my friend, what's going on? How are you?
Doing well. Yeah, this is an important topic. My wife's father died last year, and that was just kind of a wake-up call to us to, in the family, and then also me as a professional, that we have to really make sure we get ahead of this kind of thing when it's inevitable, like you said. Yeah. It's inevitable. It's not. It's inevitable. Maybe yeah. It's a definite going to happen where any married couple, one of you is going to be alone at some point. We need to plan for that. Yeah. So we getting past the empathy, we do have to do the financial planning side of things as well. Yeah. And so, it's a topic we need to discuss. So we've got to bring
we're going to jump in and do it. And I'm right there with you. I don't know if I've shared it with you before or our listeners here, but the house that my wife and I live in, when we purchased it from the lady we got it from a few years back, her husband passed away unexpectedly. They had no plans in place of any kind. And she spent 3 years cleaning up the property and the home and everything and getting their financials and stuff. She just sorting through the mess for 3 years. Mm-hmm. And one of the things she shared with me when we were just chatting, and she was like, "What do you do for a living?" And I was telling her what I do for a living. And she's like, "Boy, I tell you what, I wish I would have talked to somebody." She's like, "Because I never got the chance to mourn the man. I went right into fix it mode." Right. Yep. And she never got the chance to properly grieve for her husband of 30 some odd years. Mm-hmm. So it's not pleasant, but it is necessary. So let's start, John, with just a couple of big ticket items here. Number one's probably pretty easily guessable for people, but let's go through those. What's the first one?
Yeah. So the number one thing is obviously the income gap. So if your spouse had some sort of pension plans can have different results when a spouse dies, whether you continue at 100% of their level, 75% of their level, 50% of their level, or it's gone. So that's something that when your spouse is ready to start signing up for their pension, we want to go through these different possibilities. Sometimes it's already happened. So we have to kind of say, okay, if and when this happens, how do we navigate through this? Because you're going to perhaps lose the entire pension or have half of it. So that's one of the big things. Social Security is another one. Yeah. If your spouse dies, depending on what your current Social Security level is, you may be entitled to half of what your spouse had, or whatever yours is, whichever is higher. Right. But that is something that's also a very big consideration. But the income gap is the biggie. That's one thing you have to plan ahead for, is knowing that if something were to happen, what is going to be the income gap and how do you deal with that?
Okay. Yeah. I mean, that's the first one. We're going to talk about how to do this, deal with that in just a second. So what's the second piece that most people just don't see coming, even though when you stop and think about it for just a few seconds, you're like, well, yeah, it makes absolute sense, but you just don't see it coming because, again, you're more in the emotional state of things. What's the next one?
And this one actually does catch people off guard, even as common sense it is. And that is, instead of filing jointly on your taxes, you're going to be filing as a single person on your taxes. Yeah. So that is something that really catches people off guard because your thresholds have been basically cut in half. Right. Your standard deduction is cut in half. So if you have the same income, let's say you're blessed to have the same income, but now your thresholds are higher, you're going to be paying more in income taxes. Yeah. And that catches people off guard where they had been maybe doing either estimated taxes or some withholding at a certain level, and all of a sudden there's a big jump in taxes, and they're shocked. They're like, "Wait, what? I now owe $6,000 or $8,000?
Let's say, if you've been fortunate enough to be married to somebody for 30, 40 years or whatever, and you're just so used to, you're in the rhythm of filing, married filing jointly, or and then all of a sudden you got to go to single filer. It's a big change, right? And it just catches people off guard because you just You're just not used to doing it. So those are the two biggies. So let's kind of focus on the first piece here, which is solving the income gap issue. Now, you mentioned the Social Security. So there's lots of different strategies in place there. And I want to have you give me a couple of bullet points for some alternates. But when you mentioned Social Security, it got me thinking. Some advisors will talk to their clients about saying, okay, whoever's making more money, maybe the strategy, and again, just a maybe, is maybe that person keeps, holds that off until 70 to allow that to get, to go really high. And the person making a little less, maybe they take theirs earlier, to kind of shore things up while we're both still around, because then that leaves you that higher number. When one gets lost, to your point, you get the higher of the two. So that's a strategy. There's lots of different things you can think about for solving the income gap. What are some others?
So one of the obvious ones is life insurance. People don't like to talk about life insurance, but life insurance is certainly an option here. If you already have life insurance in place, you might want to keep it and keep paying for it. It might even be the point where it's what we call paid up life insurance.
Right.
And I don't get too much into the weeds, whether it's term or whole life. There are strategies we can use with whole life insurance, otherwise known as cash value life insurance, where you can use some of that to help pay for long-term care in the future or any terminal illness if you have issues in the future. Mm-hmm. So the whole life or cash value life insurance does have a place. But if all you have is term insurance and you're paying on that, again, that's not the worst thing you can have as well.
Right.
But insurance is one of those things that can help bridge that gap. We usually think of insurance for younger people to make sure that the mortgage is paid off, the kids can get paid, college is paid for.
Right.
But it can also be for a spouse in case your mortgage isn't. There's people that are 70 years old and still have a mortgage. So
income replacement, regardless of your age.
Absolutely. Yeah. And so this is maybe not to, you maybe don't want to be overinsured,
right?
But it is something that's helpful. Again, I like the idea of making sure that mortgage is paid off, and there might be a small bridge to help again with the remaining spouse for whatever may be coming up, and make sure that you have burial costs and all that. These things aren't cheap either. Anybody that's been through this knows that there are costs there, and they have you at an emotional time. Not to say that they're doing anything unethical, but you tend to not make great decisions at that time, and so you may just pay for a little more than you normally would have because you're in an emotional state, and that's what life insurance can help with.
Yeah, so that's one. Another one, obviously, I'll drop the A word here. John, because that could be a tool where people use annuities, right? That's certainly something that's been useful over the last couple of years. The point being is that whatever the tool is, you need to solve for the income gap, right?
Yes.
So you've got to work with that strategy or work with someone on building that strategy, because if you're used to, I don't know, let's just go with a number and say you're used to having $7,000 a month come in, and now you're by yourself and you're only going to have $4,000 a month come in. At first thought, you might sit there and go, again, to your point, especially if you're emotional, you might go, well, there's only one of me now, so that's fine, whatever. It's not going to cost as much. But unfortunately, utilities, cable, they don't turn around and give you half off because you've lost your loved one, right?
No, they don't. So yeah, the budget, the B word that people don't like to talk about is something that we have to at least go over. We don't have to have every last penny figured out, but we do have to know if something were to happen. And when I do my long-term planning, we do account for that, the budget differences as we get older. When you're younger, again, we travel more. We don't travel as much as we get older just because of the inability to move as well. But there are also higher medical costs. But if one of the spouses is no longer here, then some of those medical costs could be less. But we just don't know. Those are one of the we talk about in another podcast accounting for that.
Yeah, but then again, you might wind up having a big medical issue once you become by yourself, and then so then it's going to cost. So again, solving for the income gap has just got to be at the top of the conversation piece. And what both of us kind of kicked this podcast off sharing stories of people that we know that did not, have things in place. And this is a conversation that, while not fun, you could certainly just get out of the way while you're both around and have that kind of, lack of a better term, peace of mind, knowing that whomever goes first, the other one's going to be all right. Right. I mean, it's just that simple.
Yeah.
It can come down to that. Right. So let's just assume, John, that we've taken care of things on the spousal side. Okay. Mm-hmm. We've got stuff in place. We've done the right thing with our pension. If we were lucky enough to have one, we've maybe selected the right option there. If it's the spousal continue or whatever. Now we can focus on what we want to do for the legacy, for the heirs, if you will. And some things here have certainly changed. And obviously this Secure Act 2.0 that the government, put through just a little while back has changed. They did it with 1.0 and then they changed some more rules in 2.0. But if let's say the one spouse has passed away and now it's just you and you're passing away or whatever's going on, how you're leaving the rest of that money to your kids, tax conversation becomes a huge piece of this, right? Because that is the big component there.
With the ending of the stretch IRA, that has really caused a planning challenge out there. I want to say it's a bad thing. These are first world problems. If you have some money, it's great that you can leave a legacy. However, when you pass away, your children are going to be at an age where they're probably at their peak earning years. Now, nowadays with a traditional IRA, you have to empty that account within 10 years. Whether it has to be done year by year or just at the end of 10 years, either way, it still has to be, the account has to be emptied within 10 years.
Right.
And your children may be in their 50s when they inherit this, and they're required to do this. So their peak earning years, having this additional IRA money they're having to take out, required by law, that's going to hit them into kick them possibly into even higher tax bracket. It can be a tax nightmare. Now, again, you're leaving a legacy, but that legacy is not what you intended. And this is why we want to make sure that we do our planning ahead of time, whether it be a Roth conversion or just knowing how we're going to take money out of our IRA accounts. But that is definitely a ticking tax time bomb that you have. And if you just ignore it, the government's going to get a larger portion of your hard-earned money that you've saved so diligently for no reason. So we really want to plan on that.
Yeah, that's one option. And I want to get to some more, but if you're watching this on video, you'll see behind John, there's a picture of a little bomb and it says diffuse. But if you can't see it because it's kind of small, check this out. John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by rescuemyretirement.net. That's rescuemyretirement.net. Fill in the basic info and he'll ship those out to you immediately. That's rescuemyretirement.net for a copy of Diffuse and Tax-Free Retirement in California. So again, if you'd like to pick up a copy of those books that John's got on tax efficiency, being a little bit smarter with your tax situation, again, just reach out to him, let him know at rescuemyretirement.net. That's rescuemyretirement.net for your copy of Diffuse, as well as tax-free retirement in California. All right, John. So tax time bomb, one thing for the heirs. Another thing to consider really is just the communication factor, right? We talked about this a little bit before, a couple of weeks back, I think it was, but it's really just like having the chat with your kids about what you want to happen. Because a lot of people will go, well, my kids won't fight about it. Not a big deal, whatever. And it's like, nah, money makes people funny. So just get it out of the way and have that conversation. Get your BDs taken care of, your beneficiary designations. Get those all checked off to be the right people.
Yeah, I pointed out to in a previous podcast that I have an estate planning checklist. I have one. I kind of always keep one around my desk. If you want this, reach out to me at clients@mirrorsmoney.com. I'll send you this estate planning checklist. And it kind of goes over a lot of your wishes, your final wishes. So it's not your trust. This is what you want for your funeral. This is what you want for your obituary. This is what you want, perhaps even part of your eulogy. Just some important things that go through your mind. What type of a ceremony do you want to have? And it also has obviously the contact information for any professionals, where your accounts may be, all the other obvious stuff. But I think it's really important to have this so that your spouse, your children, everybody is aware of this. Your advisor, we always want to keep this on file. I also think it's very important that you communicate to your kids what you have as far as what you're leaving to them. For my larger clients, I am happy to sit down with the client and their children when things aren't emotional and kind of go over what they have, who's getting what. So this known ahead of time, not after the fact. And so that gives you an opportunity to explain your wishes or why you like to, why you have some, your intentions may be different than what the kids are expecting. Yeah. The beneficiary designations are so easy and so obvious. So that's one of those huge problem is an easy fix. And so we go over those again about once a year within our client base, just to make sure that, 20% is here, 30% there. And I actually go beyond the percentages. I actually tell the clients how much money in dollar amounts you're leaving to this child, that child, or to a nephew or a niece. So it's important that we do that. But these are common mistakes that are easily rectified and that we always want to stay ahead of. And people, again, they get emotional. And like the woman you spoke about at the very beginning, where she had no time to grieve, this allows you the time. It's so important to have that time to grieve, to reminisce, enjoy the happy thoughts of whoever your loved one was that has passed away, and actually give that person the proper thoughts that you want to have, rather than worrying about, well, where's the life insurance policy? Where are the accounts at? We don't want to go through all that.
Yeah. I mean, and even working with a professional, right? So a lot of times for DIYers, there's certainly, and that's what they were doing. He was very DIY, the gentleman, just around the home and doing things anyway. But then, obviously they took no plans, no strategies financially. And so she's left to completely scramble. And do you really want to leave that behind? Right now, he passed away unexpectedly, so I get it. But the longer you put that stuff off, those conversation pieces off, the more it's going to just kind of compound, right? So just get it done, have the conversation so that you're not leaving as that person, obviously already grieving for you, but then also scrambling to just make these decisions. And a lot of them can be done fairly easily. And if you're doing them while you're here together, John, you guys can plan for these things, right? You can talk about what's going to happen. Should you go first? Should I go first? What are we going to do with the kids? So on and so forth. Yeah,
it's important. Yeah, while you're of clear-minded, while you're of clear mind and you want to talk about this, even if you don't want to talk about it, this is time to get that out of the way. My friend Dan Caprill points out that the average age of widowhood is 59 and a half right now. So it's a lot younger than people think. Yeah. So when we talk about people passing away unexpectedly, that's how it happens a lot of times, where you're healthy and then all of a sudden something happens, and can happen quickly. And if you haven't planned on this, and again, you don't want to be thinking about this while somebody's terminally ill either. So you want to get this while you're both healthy, while you're both able to talk about this. Let's get this out of the way now, so we can get your wishes taken care of. So important.
Yeah. 59. Wow. Really?
Mm-hmm. Very young.
Mm-hmm. Very. All right. Well, so let's jump over and we're going to wrap this up, obviously, here on this side of things with the conversation. So sit down, have a conversation, reach out to John if you need some help. Find him online at mearsmoney.com. That's mearsmoney.com. But let's go to the 2-minute warning. All right. And so we're back here. We're going to do the email question this week, John, on the podcast. It's from Valerie. And we looked through some emails, and now we found one that was fitting for this week's topic of conversation. She says, my husband passed away, John, 15 years ago. And I've dated, but never considered getting, really serious with anybody. But the boyfriend's house would work better for us than mine. And I'm in the place now where I want to move things forward and move in with him. But it makes me really nervous to sell my house and start combining finances because I've been independent for so long. So, John, how do you advise people in situations like this? Because Valerie's, kind of wanting to know, what's some trains of thought to think about should you find yourself in this situation. To our point earlier, 59 is widowhood, which is wild that's the average. So many ladies out there may find themselves in the similar situation.
Mm-hmm. Yeah, it's not that unusual of a situation. A younger widow and having 15 years and meeting somebody new that that you're spending the remainder of your life with. There's several. Yeah, exactly, absolutely. So there's several things. One thing that I do know that's important, and I've seen this happen far too often: communicate with your kids. So always make sure that this is, because kids are they get very protective of their parents.
Yeah.
And so as they get older, they're always, I've seen this far too often, they're leery of this other person,
sure,
even if the person has the greatest of intentions. So communicate with your kids. And I had a client recently say this: I told my adult son, but I didn't ask him permission to be with this person. So that's one of the things that you have to let the kids know. You're not asking for permission. You're telling them who you're going to be with. And I think that's really important.
Because I can see that, John, being the case, right? Well, don't sell don't sell my dad's house, right? Or something like that, right? In this situation. And it's like, well, it's not your dad's house, honey. It's my house, but it's a good question. That's a great point is talk, even with adult children, we can get a little goofy about that. Yeah. What's some other things to think about for Valerie?
So one thing that is also an obvious thing is, and again, had to run across this before, the good old fashioned prenuptial. As we're adults, I think people are more open to that idea rather than when it's 25 and it's just about romance. If you're 65 or 70,
if you're seasoned,
you understand. If you're seasoned, you understand this more from a pragmatic standpoint. And if your spouse doesn't understand that, maybe they are not the right person for you, but that's something you can bring up ahead of time, saying, by the way, there's a legacy from my former spouse. There's also a legacy from my side of the family, and we want to keep it separate that way. Keeping your finances actually separate isn't a half bad idea as you get older.
It's not hard.
Either. It's not hard. So the accountants don't have to be joint accounts. You can have a small joint checking account to pay the bills with, but otherwise your assets can be your assets and the other person's assets can remain their assets. So
John, my wife and I have been doing that since we got married. I mean, we've been married 20 years and it was a second marriage for her. Sounds like possibly same for Valerie, first for me, but we were just like, we were functioning adults. So what, she has her thing. I have my thing. To your point, we take care of the homestead together, but, I tell you what, it's one thing we never fight about is money.
Mm-hmm. Yeah, that's something, again, if you're open with your spouse, you don't want to have a hidden account, so to speak, although maybe a little bit. But
because you want to really on a golf club or something.
Yes, but you do want to be open with them. And again, that's communication with the other spouse.
Yeah.
That if you have separate accounts, it's okay to be open with them. By the way, I have $1 million in my IRA. That is going to my kids. There are ways we can set that up so that the boyfriend may not have any rights, but if you do get remarried, they can have some rights.
Right.
So prenup is one thing. A living trust is also something you can still do. I know sometimes we oversell living trust, but might be a space where living trust would be beneficial.
Okay.
Where if you want your boyfriend or new spouse to have a portion of the proceeds or some living expenses, there are a lot of things we can do to help set that up so that person isn't left down and out, which nobody really wants either.
Sure.
So there's things we can do there where you set up, accounts where they can actually be able to live off of some of the proceeds from perhaps the sale of the house or something else. But again, the main thing I see above all else is still communicating with your kids. Everybody's different. So I can throw out there's so many more ideas I can go over here. But the main thing is communicating with your kids and then having a plan and being open with your new spouse or your significant other as you get older to make sure that nothing is, misunderstood, because these can be, again, the kids are the ones that are always looking out and protective of their parents.
Not the worst idea, Valerie, to keep things separate, but certainly sit down with a qualified professional and talk with them and just kind of go through. Both of you guys come in, right? You and the new person come in and sit down and figure out the best strategy overall for you guys that is going to work well for your unique situation, because everybody's different, right? I mean, we all may find may move on in life and find another person after we lose our loved one, but at the same time, there's still those pieces that apply to us, right? We all want to make sure that we're comfortable and happy and safe and feel loved and taken care of and all those kinds of things. So just sit down and have a conversation, and hopefully you guys will work through that. If you need some help, reach out to John. Stop by his website, mearsmoney.com. Lots of good tools, tips, and resources at mearsmoney.com. You can check him out online there. And of course, you can subscribe to us on Apple, Google, Spotify, YouTube now as well, which you can just type in the name of the podcast and search it that way, which is Red Zone Retirement Program, or you can just find it at John's website, mearsmoney.com. All right, my friend, thanks for hanging out with me as always. I appreciate you breaking it down, Coach. Have
a lot of fun.
Week.
Yes. Thanks, Mark.
And good luck on the next upcoming games. Hopefully footage gets shared with you. If you catch out our last podcast, we were talking about that. Hopefully you won't have that.
Hopefully we have more information. Yes.
Planning's good.
It is. Planning's great.
There you go. All right. We'll see you next time here on the show. This has been Red Zone Retirement Program, Simple Investing, Smart Future with John Mears.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.